Today sees the launch of our final bi-monthly report for 2017, reporting on trends and transactions in the Irish property sector as we enter the final straight of what has been a busy year, despite the fact that absolute returns and transaction volumes have moderated somewhat year on year. Investor appetite for Irish real estate has continued unabated in 2017, with existing investors and a steady stream of new entrants continuing to seek opportunities across a range of sectors, including some of the alternative sectors that have been gaining momentum, such as build-to-rent, hotel investment and student housing, as well as the more traditional sectors. The autumn season has been particularly busy, as is generally the case, with many assets having been formally released for sale during September and October. Negotiations are now ongoing in an effort to conclude as many of these transactions as possible before Christmas. Activity in the occupier markets has been strong in 2017, with the Dublin office market being an exemplar performer, boosted by strong job creation figures and continued healthy volumes of foreign direct investment. Investors continue to cite Ireland's strong economic backdrop, levels of occupational activity, and the potential for further rental growth and yield compression as rationale for investing. Take-up in the Dublin office market during the first 9 months of 2017 reached more than 183,000 square metres, an impressive result considering that annual average take-up in Dublin in recent years has been in the order of 200,000 square metres per annum. The fact that there was an additional 100,000 square metres reserved at the end of Q3 bodes well for take-up volumes in the next quarter, and indeed for the 2017 as a whole. Several large mandates that have been in the market for some time have now reportedly shortlisted buildings, which will boost take-up over the next few quarters. With pre-lettings accounting for approximately 1/4 of take-up in Dublin at present, it's likely that all of the more than 270,000 square metres of new office stock that was delivered in the capital 2017 will have been fully leased up by year-end, demonstrating that new supply is being delivered in a very measured fashion in this cycle. Prime office rents in Dublin have now risen to approximately €681 per square metre or €63.50 per square foot, and are likely to reach €700 per square metre by year-end. Meanwhile, prime rents in the suburbs of the capital have also increased recently. Take-up in the Dublin industrial and logistics market in the first 3 quarters of 2017 at approximately 170,000 square metres was down about 20% year on year. This is somewhat disappointing considering the volume of demand for modern industrial accommodation in and around the capital. Over the last couple of years, the market has been characterised by a significant shortage of modern accommodation in locations that are preferred by the end users, leading many potential industrial occupiers to opt for design and build solutions. However, now that prime rental values have reached a level that justifies new development, we expect to see this situation alleviated. It's therefore not surprising that there's been an increase in demand for well-located industrial sites capable of accommodating modern industrial and logistics facilities, particularly against a backdrop of increased appetite as a result of Brexit. Industrial and logistic developers are no doubt encouraged by the volume of active requirements in the market at present, with more than 117,000 square metres of active demand prevailing at the end of the 3rd quarter, and at least one live requirement for more than 200,000 square feet. Having increased by 6% in the first half of 2017, prime industrial rents in the capital remain stable at approximately €99.50 per square metre as we approach year-end, while rents for secondary and provincial properties have increased to approximately €62 per square metre and €53.80 per square metre respectively. Retailers are now fully immersed in their Christmas trading programmes, and as a result, we expect to see less focus on securing premises and concluding property transactions in this sector until after the new year. The primary focus for retailers over the next 2-month period is capitalising on the underlying strength of consumer appetite in the Irish market, maximising footfall and growing sales activity both online and in-store. With sterling remaining weak, it does remain to be seen what extent these efforts will be challenged by leakage to Northern Ireland and indeed to UK websites as the now traditional Black Friday and Cyber Monday sales approach us. With uncertainty around Brexit continuing to hamper the expansion and relocation plans of many UK retailers, much of the activity in the Irish retail sector is currently being driven by indigenous retailers, with a scarcity of new entrants very much in evidence. The majority of the retail leasing deals being negotiated at present are emanating from a distinct cohort of retailers, with those involved in the food and beverage sectors being particularly active. We expect to see strong Christmas trading period in Dublin and indeed other dominant retail locations over the next while, with Dublin city centre trading patterns likely to be particularly boosted by the welcome completion of the Lewis construction work. The opening of the long-awaited Victoria's Secret store and the reopening of Bewley's on Grafton Street later this month will also boost footfall on the capital's main thoroughfare in the run-up to the festive season. Prime retail rents remain stable as we approach year-end. In the investment sector, according to the MSCI Irish Property Index, total returns from commercial real estate in Ireland in the third quarter were 2.7%, with annualised returns to the end of the third quarter more than 10%. The recent unexpected hike in stamp duty for commercial property in Budget 2018, where it rose from 2% to 6%, will have a one-off hit of approximately 3.8% to property valuations and pension fund values in Q4. This will see the 2017 annualised return from Irish commercial real estate easing back to single digits, albeit this rate of return remains attractive compared to those being achieved in other European locations. Demand still remains strong, regardless, with core and core plus investors chasing a limited supply of product. We may also see assets being sold through special purpose vehicles over the next year, as was the case when the rate of stamp duty was at or higher than 6% previously. Another budget measure that may change the trajectory of the property investment market somewhat is relaxation of the capital gains tax relief rules, which were first introduced in 2011. As a result, real estate assets bought between 2011 and 2014 can now be sold after a 4-year hold period without incurring CGT, as opposed to what was originally a 7-year hold period. This may result in some additional assets being released for sale over the next number of years, particularly those that were purchased by private investors. Approximately 1.3 billion of investment transactions completed in the Irish market in the first 9 months of 2017. The likely outturn for 2017 is therefore expected to be in the order of 2.25 or 2.5 billion. However, estimating annual investment spend at this point is difficult because it depends on how many deals complete before year-end and which ones fall into 2018. Prime office yields hardened in the last month on the back of new transactional evidence, with prime yields in this sector now trending at 4.25% and likely to strengthen further over the coming months. Prime yields for multifamily investments are also trending at 4.25%. Meanwhile, prime high street yields remain steady at 3.15%, with prime industrial at 5.5%. Our research shows that approximately 456 million of development land transactions were traded in the Irish market in the first 3 quarters of the year. Based on transactions that are expected to close before the end of 2017, we expect the overall volume of spend in the development land sector to be broadly similar to last year's outturn of approximately 800 million. With a few notable exceptions, transactional activity continues to be dominated by relatively small land parcels. This is obviously disappointing, considering the pent-up demand for development sites in the market at present, particularly in the residential sector in core cities such as Dublin, Cork, Limerick and Galway. One of the more encouraging announcements of late was from the Minister for Housing, Minister Eoin Murphy, where he intimated that government are prepared to consider reviewing urban building heights in Dublin, relaxing car parking ratios in schemes that are within 1 kilometre of a DART or a Lewis line or urban rail, and also looking at facilitating co-living options in urban locations. While this and many other policy announcements made over recent weeks have been welcome, and offer solutions that have the potential to unlock much needed supply, we now need clarity to enable these plans to be put into action and facilitate timely delivery. Transaction volumes in the Irish hotel market in the first 9 months of 2017 were somewhat disappointing, with only 23 hotel sales totalling 87 million between them having completed in the year to the end of September. The final outturn for the year will, however, be considerably stronger, with several significant transactions, including Carton House Hotel in Maynooth, County Kildare, and the Knightsbridge Hotel in Trim, County Meath, now nearing completion, and Galway's Radisson Blu Hotel having recently changed hands for a reported €50 million. We also understand that negotiations are now almost completed on the investment sale of the Gibson Hotel in Dublin Docklands. This will be the largest Dublin hotel to trade in 2017. The hotel sector welcomed the Irish government's decision to retain the 9% rate of VAT in last month's budget, although the 4 percentage point increase in the rate of stamp duty from 2% to 6% on non-residential property sales took the market by surprise and is certain to have an influence on hotel purchases going forward. As we approach year-end, the Irish hotel industry continues to trade well, according to the latest indicators, with Dublin performing particularly well. With limited room for improvement in occupancy rates in the capital, the focus is now on improving average room rates and RevPAR. Activity in the Cork market has been relatively strong over the autumn, with a good volume of investment stock released for sale over recent months. Investor appetite for opportunities in Cork has increased noticeably, buoyed by the strength of underlying occupational activity and comparatively more attractive rents and yields compared to Dublin. Considering the weight of capital seeking investment opportunities in the Cork market, prime yields in this market have also hardened of late, with prime high street retail and prime office yields now at 5.75% and 6% respectively, and yields in all sectors potentially trending stronger over the coming months. There are a number of active office requirements for Cork at present, which will boost take-up in the city in due course, and may give developers and indeed their funders the confidence to commence construction on some of the many schemes that already have the benefit of planning permission. Prime office rents in Cork City remain steady at approximately €312 per square metre as we approach year-end, but we do expect this to increase over the coming months as new transactional evidence emerges. So all in all, the next 2 months are expected to be very busy across all sectors of the Irish property market, as the usual scramble to get transactions signed before year-end commences in earnest. To download our full bi-monthly report, please visit the newsroom of our CBRE Ireland website at news.cbre.ie.